Hello and welcome to another market update.
My man!
Let's just get straight into it with a summary of some of the stories I'll be getting into today. So, last Thursday, U.S. inflation came in hot at 8.2% for headline CPI and 6.6% for core, which I believe was a 40-year record.
God damn!
Then U.S. housing permits caught a little boost, but housing starts slowed down significantly. UK inflation hit 10.1%, and the Bank of England is trying to rein in some of its government spending.
Oh, hell no!
The Bank of Japan warned it will intervene in the FX market again if necessary.
For real? You fuck with that?
China calms its markets leading into President Xi's re-election. The U.S. is considering selling more oil from the Strategic Petroleum Reserve to combat gas prices.
You're a fucking idiot.
And Mastercard is helping banks offer cryptocurrency trading.
Say what?
All right, but before I get into those, let's go over a quick recap of last week. So, last week, Cathie Wood sent an open letter to the Fed urging them to pivot. The U.S. issued aggressive semiconductor rules that severely affect China.
And we say bye-bye!
Russia rained down missiles after the Crimea bridge attack. The Bank of England said it was ending its bond buying stimulus. Biden said he is re-evaluating the U.S. relationship with the Saudis after the recent OPEC decision to cut production. Some European nations are fighting nuclear and natural gas being labeled as green.
No!
And Binance had $100 million stolen in yet another crypto hack.
Damn!
All right, with that out of the way, let's jump into the stories for this week, starting with inflation. So the consumer price index for all urban consumers rose 0.4% in September on a seasonally adjusted basis after rising 0.1% in August. Over the last 12 months, the all items index increased 8.2% before seasonal adjustment.
Damn!
Increases in the shelter, food, and medical care indexes were the largest of many contributors to the monthly seasonally adjusted all items increase. These increases were partly offset by a 4.9% decline in the gasoline index. There were some indexes that declined in September, including those for used cars and trucks, apparel, and communication, but overall, we're seeing a broader increase in prices still, unfortunately. Now, I just wanted to highlight some of them. So, food year over year increased 11.2%, and then month over month it increased 0.8%. So on both fronts, not looking good.
Yep!
And if you look at energy, even though it was, energy in terms of gasoline specifically, even though it was down 4.7% month over month, which is a good sign, the direction people want to see it headed, it's still up 19.7% year over year.
God damn!
Which is far from ideal. And then we had core inflation, which is the big story because core inflation is what the Fed uses to inform their policy. Like they are trying to get 2%. Their 2% target is related to core inflation, not headline. So, I mean, not that they don't care about CPI headline, but, they could kind of care less as long as core gets down. But core has been worse. It's been headed in the complete wrong direction. Headline, because of the decline in energy prices, has retraced a little bit. We had 8.2% versus the 8.3 previous, so a downward move. But core inflation has been headed higher. And that is largely because of shelter, which increased 6.6% year over year and 0.7% month over month. Now, shelter accounts for it's the largest basket in core inflation, and I guess in all inflation, just because it's such a huge expense. It's like 40%. So those increases are, understandably so, going to affect the headline numbers dramatically. So let me just continue here. So the index for all items less food and energy, so core inflation, rose 6.6% over the past 12 months, the largest 12-month increase in that index since August 1982.
Not crazy.
The shelter index also rose 6.6% over the last year, accounting for over 40% of the total increase in all items less food and energy. So it is by and large, the biggest factor in core inflation, and that is partly why we're seeing this uptick in core inflation. Now, there is a lag because rent and I guess shelter costs, the way they are calculated is largely through what is called owner's equivalent rent, and there's a little bit of a lag, at least maybe 12 to 18 months lag of prices that are then reflected in the CPI or core CPI numbers. So, because recently we actually saw rent prices going down for the first month, and this is more not necessarily forward-looking data, but not as nearly as backward-looking as the CPI or core numbers. So, even though that lag is hitting, I guess right now in the numbers, which is still a big deal because people did have to pay that, and that was inflation. But at the same time, those numbers should be declining in the coming months. And again, monetary policy affects of the lag, so the effects of interest rates rising are probably not reflected in the current numbers right now. So that probably will be lower going forward. But as it stands right now, shelter, food, and really a lot of other things, but those specifically are really driving inflation. Food is obviously not in core, so in core inflation, it is largely shelter. But I just wanted to touch on that because it's important to dive into the specific baskets where we're actually seeing inflation rather than simply focusing on the headline number.
Totally.
All right, with that out of the way, let's transition to the next story. So housing starts were down this year, or actually up. So I guess I'm saying down overall because if you look, for those who are watching, if you're looking at this graph right here, they have been on a steep decline in the last month that was recorded. So August was a steep drop from July, and we have, I guess, increased housing starts since then. But if you compare those to July, it is not even half as many in terms of the rate of change. So building permits in the U.S., a proxy for future construction, went up 1.4% month over month to an annualized 1.564 million in September, beating market expectations of 1.53 million. Approvals of units and buildings with 5 units or more surged 8.2%, while single-family authorizations dropped 3.1%. Permits rose in the Midwest 4%, in the South 3.1%, and the West 0.3%. But fell in the Northeast minus 9.4%.
God damn!
So overall, building permits, which again is a proxy for future construction, in the longer term have been trending much lower for obvious reasons. The economy is, in a broader sense, contracting. Mortgage rates are rising, and so people are less, excited to build. But we still saw a slight uptick from the previous month. Hard to get excited about that when you look at the larger trend and just how much it has dropped since previous months like July and prior. But at the same time, still something to keep in mind. But let's transition to the next housing story. So housing starts. And housing starts, I'll actually read this. So housing starts refer to the number of new residential construction projects that have begun during any particular month. Estimates of housing starts include units and structures being totally rebuilt on an existing foundation. So with that in mind, housing starts in the U.S. slumped 8.1% to an annualized rate of 1.439 million, down from a revised 1.566 million in the previous month and well below the market consensus of 1.475 million, obviously. So the U.S. housing market has been hit by soaring prices of materials and rising mortgage rates, which recently reached their highest level since 2002. Mortgage rates actually, I believe, went over 7%.
Not crazy.
Very crazy indeed. So single-family housing starts dropped 4.7%, the lowest level since May 2020, while the rate for units and buildings with 5 units or more decreased 13.1%. Starts were down in the South, minus 13.7%, down in the Northeast, minus 12.5%, down in the Midwest, minus 2.7%, but we're up in the West, down in the Midwest, minus 2.7%, and then up in the West, 4.5%. So overall, housing starts are definitely being affected by the monetary policy, just rates going up and I guess costs in general. Nobody wants to build a house when nobody's willing to buy because they can't buy because mortgage rates are so high that You get used to buying. If you think about mortgage rates being low, that basically means you can buy the maximum size house possible because you can lever up an incredible amount. But as mortgage rates go higher, you can't lever up as much. So the house you're able to afford is just, for lack of a better term, worse. And so in that sense, you're not going to downsize. Most people don't want to. So you're not going to buy a new house if it's worse than your current house, likely. So that is a big part of why you're not seeing new homes being built, because there just isn't going to be that much demand when interest rates are this high. All right, well, that's housing. Let's transition to the UK. So UK inflation, like I mentioned in the beginning, came in at 10.1%, above forecast of 9.9%. So this is pretty bad. Got that 10 handle, which, not that, definitely far from ideal, especially for a developed economy.
And we say bye-bye.
So the annual inflation rate in the UK rose to 10.1% in September, returning to the 40-year high hit in July and surpassing market expectations of a 10% rate. The largest contribution to the increase was from food, 14.8% versus 13.4% in August, namely oils and fats and dairy products. Consumer costs also grew sharply for housing and utilities, 20.2% versus 20% the previous month, amid soaring prices for electricity, gas, and home fuels. On the other hand, cooler price growth for motor fuels further slowed inflation for transportation, 10.6% down from 12% the previous month, as the average petrol and diesel prices were at 175.2% and 0.2 and 186.6 pence per liter, respectively, compared to 134 and 137 pence a year earlier. And the annual core rate, which excludes energy, food, alcohol, and tobacco, rose to a record high of 6.5%, compared to expectations of 6.4%. On a monthly basis, consumer prices rose by 0.5% in September, unchanged from the previous month. Now, if you look at this graph of the inflation for the UK, it has been nothing but up. We had a slight, retracement after the 10.1% in July. We went to 9.9 for August, but now we are back at the 10 handle. So upward momentum is definitely still on the table. I'm not going to call a peak or say it's not a peak, whatever, but 10.1% is not good no matter what. I mean, even if you do fall from here, you're still going to be in the 9 handle, 8 handle, whatever. So UK inflation, not good, especially with everything else going on in their economy. Aww. All right, let's transition to another Bank of England story. All right, so the Bank of England rate hike push set to slow as Hunt, the new finance minister, tightens screws on the economy. So the Bank of England looks to set to slow its interest rate hikes after Britain's new finance minister ripped up a stimulus plan. So for those who don't know, Truss, the new prime minister who got in there, Liz Truss, who got in office after Boris Johnson was removed.
And we say bye-bye.
She went on a little bit of a, spending spree, just tax cuts and subsidies and just a total financial stimulus to kind of help the economy. But this was also in the midst of the inflation, 10%, which is crazy. So you had the British pound just take a dive, and the gilt market, the British bonds, the UK bond market, also had a massive spike in yields that put a lot of over-leveraged pension funds at risk of margin calls and solvency issues.
Yep.
So that was a big deal, and now people are trying to rein in their spending to kind of get, their economics and their finances in order. So this new finance minister is basically ripping up this stimulus plan. That's the gist of this. So Jeremy Hunt on Monday stripped away most of Prime Minister Liz Truss's planned tax cuts and shortened her huge energy price cap plan to 6 months from 2 years. Because Liz Truss was planning on subsidizing a lot of business energy. And so he basically, I guess he's not getting rid of it, but he shortened that plan to 6 months from 2 years. And also was tightening these screws on the world's 6th biggest economy in 2023. So investors have also pared back their bets on the peak for the Bank of England bank rate, so the terminal rate for the UK, which they now see at 5.25%, up from the current 2.25%, so a long way to go. I mean, that's 300 basis points left of hikes as they see it. But still, that 5.25% is down from the almost 6% predicted earlier this month. So the Bank of England is in a bit of a unique situation with so many moving parts. The fact that so much fiscal stimulus has been reversed and the energy support has been curtailed does reduce the pressure on them somewhat. If it relaxes the pace of its interest rate hikes by more than investors expect, it could further weaken the value of the pound, which has fallen by 16% against the dollar this year, aggravating inflation pressures. So pretty much like every other currency, it's been just falling victim to the dollar wrecking ball. So businesses will also be exposed to higher energy bills, just as they are due to be hit with a jump in corporation tax, part of Hunt's drive to restore Britain's fiscal reputation. While interest rate hikes could give Hunt an extra headache by increasing the government's debt interest costs, analysts expect a smoother relationship between the central bank and the government after strains in recent months, as allies of trust accused the Bank of England of failing in its inflation fight. So there was a lot of tension between the political figures like Truss in the Bank of England, in the English government, and then the actual Bank of England, like the finance minister and the people who handle monetary policy. And there's a huge disconnect, which is just creating a lot of disorder and raising questions about the overall credibility of the Bank of England. So now they're kind of getting their shit together, for lack of a better term, and coming together to have a cohesive plan, not kind of attacking each other where you got tightening and fiscal going completely opposite directions. To put it plainly, the Bank of England is just trying to get it all together after what was an unbelievably volatile and damaging few weeks with the bond market and the pound crashing. So that is the Bank of England story. Let's transition to Japan now. So we got the Bank of Japan repeats its warning about intervening in the FX market to backstop the yen as the market watches for that intervention. So the finance minister is a name here. So Shunichi Suzuki warned on Tuesday that Japan would take appropriate and decisive action against excessive speculator-driven currency moves. They always say it's speculator-driven. It's their little, they're out. They always try to use speculators as an excuse, when in reality, there's obviously fundamental factors driving the speculation, but I digress. So keeping speculator-driven moves, keeping alive the possibility of more market intervention after the yen hit a new 32-year low.
Whoa.
So Suzuki also reiterated that the authorities could intervene without any announcements, but did not comment on whether they actually had done so, when pressed on speculation that Japan may be supporting the yen without publicly acknowledging it. So I would say that, I'm not saying that they aren't going to intervene. I mean, they already did, I believe, a little bit. But the way they're framing this right now is they want to keep it kind of open-ended and discreet. That way the speculators and other people betting against the yen are discouraged, try to slow it down, because if the announcements, if it can just happen without an announcement, that obviously adds a little bit of like a risk to, shorting the yen, because at any moment they could just sell a bunch of their reserves to buy yen. And that is what they're doing. So if you watch the Japan Treasury balance, because they hold the most treasuries out of any country, other than the U.S., I guess, they are selling those because they are trying to defend the dollar-yen exchange rate, right? So they are selling dollar-denominated treasuries in their reserves that they hold to buy yen. So exchanging dollars essentially for yen, and that helps drive the exchange rate a little bit. And that's what, and they have a lot. They have like $1 trillion worth of treasuries to do that, to defend the yen if they want. So they definitely have the ammunition. It's just a matter if they are really willing to do that. And in some sense, I believe they would have to get the okay from the Federal Reserve, the U.S. government, which I think they have. Just kind of unspoken understanding of like, we need to do this while you raise rates. You can raise rates, the Fed that is, and but we're gonna have to defend the yen at some point. And so I'm sure they have some sort of agreement, because there's no way they would be doing this stuff without kind of coming together. But I digress. So let me continue forward. Japan spent 2.8 trillion yen, about $18.81 billion, in dollar selling, yen buying intervention last month, when authorities acted in the markets to prop up the yen for the first time since 1998. So basically the yen, once it got to like 145 against the dollar, they were getting nervous. And that's, I believe, around the level they intervened last time when the yen got to like 146 against the dollar. So it is consistent. This seems to be a level that they like to watch, and they get nervous if the yen goes beyond that, which it is right now. The yen, I believe, almost tapped 150 against the dollar, so it's just been on a tear higher. I mean, not just in the last week, but definitely in the last week as well. So estimates by the Bank of Japan released last Friday showed that excess reserves parked by institutions at the central bank would likely have declined 4.09 trillion yen as of Monday, October 17th, due in part to actions that could be related to currency intervention. So given that the Bank of Japan is trying to be a little bit more discreet about this, people are going to be looking at their reserve balance to see what kind of fishy business is going on. If they're selling a bunch of treasuries, a bunch of their reserves, the implication would be that they're using that to buy yen, backstop the yen's exchange rate. So Kuroda, who was also appearing in Parliament after attending last week's meeting of global financial leaders, suggested that the dollar's strength may not persist.
Little bitch.
The dollar has become very strong against all currencies around the world, but few of the people I met in Washington were thinking that it would last long. Now, that is convenient for him, because I think that's kind of what Kuroda, who is the head of the Bank of Japan, who is what he is hoping for. I mean, because he's maintaining this easing policy, he obviously is banking on just being able to withstand all this, the interest rate differentials and the pressure on him and the yen until central banks like the Fed pivot and stop raising rates, or at least stop raising them so aggressively. So obviously that is, he has his own bias and he wants that. Hard to say how much longer that the Fed will continue raising rates. Realistically, it's probably until they break something or inflation really gets down to below like 4% at the very least. So I wouldn't hold your breath, but at the same time, the dollar has been on such a tear. I can't imagine it going too much higher, as measured by the DXY, the dollar index. I can't imagine it going past 120, and it's sitting at about 112 right now. So we'll see. But anyway, stark warnings from the Bank of Japan, who is willing to continue, because they already did it, intervening in the FX market.
Not crazy.
All right, next story. Okay, whoops. Okay, so for those who don't know, Xi Jinping, the president of China, he has been in the midst of this re-election campaign, and I believe he's trying to get re-elected for life, basically. So he will be president for life.
Yeah.
Which, not necessarily a good thing, but whatever. Not our country, or my country. Maybe it's yours. Anyway, so as Chinese President Xi Jinping opened the landmark Communist Party Congress, the country's vast financial bureaucracy had been busily tamping down ripples of turmoil across its currency and stock markets. So leading into this re-election, they want everything to look good. They want their economy to look good, so they're trying to suppress any problems, any volatility, any craziness as much as they can until his re-election, because if the whole country is completely disorderly leading into that doesn't make a good case for re-electing this guy for life.
Totally.
So that is essentially what they've been doing. I mean, there's a lot of ways. I'm not going to get into all of them, but that is the gist of this article. So Chinese state banks are stepping up intervention to defend the weakening yuan, banking sources told Reuters on Monday. Scores of companies have announced share buybacks or executive share purchase plans since Friday, when regulators unveiled plans to ease share buyback rules. State-owned banks vowed in unison that they would boost support for the economy, while state-run asset managers pledged in identically worded statements their confidence in the long-term and healthy development of China's capital markets. So they're all working as a unit, basically. I mean, it's a state control or a centrally controlled state government, whatever. So you got everybody kind of falling in line with Xi Jinping's plan, what he wants, what makes him look good, especially leading into this crucial election. So the whole economy is just trying to disseminate confidence, basically. So the well-coordinated, wide-ranging efforts going into the twice-a-decade Party Congress, which opened on Sunday and marks a politically sensitive time, have restored a sense of calm and stability, at least for now, in the financial markets. So the operative word being for now, because after he's presumably elected for life or just reelected, whatever it may be, there's maybe a lot of built-up volatility from them trying to hold things together, leading into this election that could surface afterwards. I'm not betting on that or saying, but I think that will be a crucial thing to watch just for China in general. After his re-election, who knows? I mean, whenever someone gets re-elected and they have that kind of cushion, even if it's only for a few years, he's going to hit the ground running, I'm sure, with some new policies, maybe some retaliatory policies or measures based off of the U.S. semiconductor rules or whatever it may be. So I would say after this election draws to a close, there'll probably be a lot more stories coming out of China that'll be worth watching.
Totally.
All right, next story. So this is a big one. What am I doing? There we go. Okay, so the U.S. could sell oil from emergency reserves this week. So the United States has already been releasing a huge amount of SPR reserves. So oil from the Strategic Petroleum Reserve. I think the original plan was to release about 180 million barrels.
Whoa.
And they have something like 14 of that 180 million left that they can release and that they are going to, especially because gas prices are rising leading into midterms, which, say what you want. I guarantee that was one of the main considerations in releasing oil from the SPR. So the Biden administration plans to sell oil from the Strategic Petroleum Reserve in a bid to dampen fuel prices before next month's congressional elections, so midterm elections. The sale would market the remaining 14 million barrels from Biden's previously announced and largest ever release from the reserve of 180 million barrels that started in May. The Department of Energy will also release further details on eventually buying the oil back, reflecting the White House's desire to combat rising pump prices while supporting domestic drillers. So they've actually, someone in the administration was really stupid in what they said. They basically said, I believe, that, as they're draining the SPR, they have plans to refill it and that they would be considering doing that at $80 or $80-ish dollars. So the market viewed that as, basically the government putting a floor on oil at $80. Now, I don't know if that's true or if they're actually going to, continue with that or try to buy and refill the SPR at around $80 or less. But that is something you need to look out for because the SPR was drained so much that eventually the U.S. is going to have to start filling it. And so in some sense, that could put a drag on oil. I mean, if you have a huge buyer like the U.S. trying to fill up hundreds of millions of barrels in the SPR, that is going to be a huge, that's a huge player in the market that is going to be driving up prices potentially in the future. But in the meantime, they are really trying to get oil prices down before the election because oil prices in general are the price that people are more aware of because you drive by it every single day. You see the prices going up and down. And so that type of inflation, even if it doesn't affect you as much, it probably does affect most people a lot just because we all drive and use energy in a lot of ways. But that is a price people are most sensitive to and recognize the most. So when that price goes up, people generally view the economy as struggling, and when it goes down, the opposite. So in general, gas prices are a good barometer for inflation that everyday people can see and feel. So the administration right now, Biden's administration, is really trying to attack that. And this is their last effort leading into the midterm elections where they're going to be releasing a fair amount of oil, 14 million barrels, I guess, from now or from when they announce this, leading into the midterms roughly. Funny. They're not even being transparent about it. Like, it's literally what's happening. But yeah, so the administration has a small window ahead of midterms to try to lower fuel prices, or at least demonstrate they are trying, said a source familiar with the White House deliberations. The White House did not like $4 a gallon gas and has signaled that it will take action to prevent that again.
My man!
Now, we'll see. Like I said, this will probably be short-lived. They can only release so much from the SPR for so long, and they're doing this just to lower prices before the election. But after that, who knows? Gas prices could easily skyrocket. Especially if the United States is going to start refilling the SPR, because think about all that oil that is no longer available for other sources or other investors, consumers, whatever it may be. So that is going to be problematic. All right. Let's transition to our final story, our crypto story. All right, so Mastercard says it's going to help banks offer cryptocurrency trading.
Say what?
So Mastercard is looking to bring crypto to the masses by making it easier for banks to get involved. The payments giant plans to announce a program Monday that will help financial institutions offer cryptocurrency trading. Mastercard will act as a bridge between Paxos, a crypto trading platform already used by PayPal, to offer a similar service, and banks, according to the company. Mastercard and Paxos will handle regulatory compliance and security, two core reasons banks cite for avoiding the asset class. Regulation is a huge thing. I mean, it drives so much of what people invest in, like at the institutional level, obviously not necessarily retail level, but retail is little money.
Little bitch.
So regulation is huge, and a lot of these institutions are really discouraged from investing in crypto or getting involved because they don't want the regulatory headache. So having someone kind of handle that side for them and ensuring compliance and consistency with the appropriate regulations is huge. May not seem huge to retailers, but again, for institutions who have huge amounts of money, like billions, trillions of dollars, that is a big deal. So Mastercard's chief digital officer said polling still shows demand for the asset, but roughly 60% of respondents said they would rather test the waters through their existing banks. So people like simplicity. They don't necessarily want to go to these other new banks, exchanges, whatever. So I wouldn't be surprised if you see more of this, where you got these legacy players kind of incorporating all these services into their business model. That way, someone who has like their 401k with Fidelity, they don't have to go make a Coinbase account. They can just buy crypto via Fidelity in their 401k.
Nice.
Large investment banks like Goldman Sachs, Morgan Stanley, and JP Morgan have dedicated crypto teams, but have largely avoided offering it to consumers. Just last week, JP Morgan CEO Jamie Dimon called cryptocurrencies decentralized Ponzi's. Oh, Jamie. At an Institute for International Finance event. If banks do embrace this Mastercard partnership model, it may mean more competition for Coinbase and other exchanges operating in the US. So Coinbase has had somewhat of a monopoly on institutional level crypto adoption, just because they are the biggest, quote unquote, safest player, at least as recognized by a lot of these institutions. So when you got more of these legacy players like Mastercard or other big banks, institutions getting involved, that definitely is going to be a lot more competition for Coinbase. So the payments company said its role is to keep banks on the right side of regulation by following crypto compliance rules, verifying transactions, and providing anti-money laundering and identifying monitoring services. Mastercard will pilot the product in the first quarter of next year, then crank the handle to expand in more geographies. And they declined to say which banks have signed up so far. How convenient. So cryptocurrencies, ironically, were meant to disrupt banks and middlemen like Mastercard and Visa, which I think they will to a certain extent, especially with the Lightning Network. That's a topic for another day. So their underlying technology, blockchain, allows transactions to move without intermediaries. Still, they haven't seen industry pushback on their involvement. Crypto is on the cusp of really going mainstream and still needs to team up with the incumbent players to get there, he said. Again, how convenient. It's hard to believe that the crypto industry will truly go mainstream without embracing the financial industry as we know it. Now, that could be true. I'm not saying it isn't, but obviously, if you are one of the industries that is ripe for disruption by crypto, you have an interest in saying that you need crypto to use you. Basically, crypto needs you to survive and go mainstream, which I'm not saying it won't help, especially because names like Mastercard are more trusted, and so that could help get adoption. But I don't think in a general sense that crypto really needs Mastercard or other legacy players to get people's adoption. It just might make it easier in the short term. But in general, I think, especially as, I guess, the stigma around crypto begins to fade, it probably won't be too much of an issue. But either way, this is a good move for crypto just for legitimizing it. We're seeing more steps like this every day. So yeah, good deal. All right, well, that is all the stories I have today. But before I get out of here, let's go over what we can look for in the week ahead. So tomorrow we get existing home sales in the U.S., with the forecast being a slight decline to 4.7 million from 4.8 million. And then we get Japan inflation numbers with the forecast of an increase to 3.2% from 3% the previous month. Their numbers are so cute compared to the U.S.
Come on, man.
And also on Thursday, we get UK retail sales numbers, with the forecast being minus 0.3% compared to minus 1.6% the previous month. Then on Sunday, China releases just about every bit of data you can imagine. So they got a ton of data from retail sales to unemployment to balance of trade to industrial production to GDP.
God damn!
Sunday is going to be a big day for China if you're interested. And finally, next Monday, we get global PMIs for Europe and the US, which should give us a deeper insight into the reality, or lack thereof, of a global recession.
My man!
All right, that is unfortunately all I have for you today. But as always, stay happy, humble, and most importantly, solvent. And I'll catch you all next week.
And we say bye-bye.